Hello everyone, I am CA Nimish Gupta and welcome to my channel Making Funds Work. This is a series of learning videos where I'll be covering a lot of topics that will help you make your investment journey easier. Do you know in India there are 4 types of mutual funds majorly? First, equity mutual funds. These are the ones which have more than 65% allocation to equity shares which are listed in India. Second, debt mutual funds. This includes all the short duration, long duration, gilt, liquid and all other type of debt funds where the debt component is greater than 65%. Third, hybrid mutual funds. This is a mix of the equity and debt where there's a balance between the risk and the returns. And fourth, fund of funds. These invest in other mutual funds, providing diversification across various fund types. In today's video, we will be covering the different types of equity mutual funds. These funds need to invest at least 65% of the money in the Indian listed equity shares. Equity mutual funds are of following categories. First, large cap mutual funds. ये large cap mutual funds क्या होते हैं? ये इन्वेस्ट करते हैं इंडिया के टॉप 100 शेयर्स में इन टर्म्स ऑफ मार्केट कैपिटलाइजेशन, जिसमें इनकी कम से कम 65% इन्वेस्टमेंट होनी चाहिए. एज एन एग्जांपल, रिलायंस इज द इंडियाज लार्जेस्ट कंपनी. As an investor, when you invest in these are considered less risky, but the return potential in long term is also a bit lesser. Second, mid-cap mutual funds. These invest at least 65% of their money in the companies which are ranked from 101 to 250 in terms of market capitalization. Third, large and mid-cap mutual funds. These mutual funds can invest 65% of the money in the top 250 stocks in India, that is large or mid-cap. Hence, they provide more opportunity to the fund manager as compared to large or mid-cap funds. Then the fourth is small-cap mutual funds. There are more than 7,000 companies listed in India. All the companies which are not in the top 250 companies in terms of market capitalization are considered as small-cap. Hence, small-cap companies are not as small as you may think. Fund manager needs to keep at least 65% of the total investments in small-cap companies. The next fund is the Flexi Cap Fund. Flexi Cap Fund is when fund manager has the choice to invest in any company, either being a large cap, mid cap or a small cap. Then the sixth type of fund is a multi-cap fund. This is a category where the fund manager needs to have at least 25% exposure each in large, mid and small cap. The fund manager can hold the remaining 25% in any company based on his analysis. The seventh type of mutual funds are the value funds. These are the funds which tend to go against the market trend and find the companies which are fundamentally strong but are trading at a discount to their intrinsic value. The eighth type of fund are the ELSS mutual funds. These are tax-saver mutual funds that help you get deduction under Section 80C. These funds invest a lot of money in shares and have a lock-in period of 3 years. The ninth type of mutual funds are dividend yield funds. These type of funds invest in companies which pay a higher dividend. Normally, these are good profit-making companies, hence this is compared a bit less risky than mid and small cap mutual funds. The 10th type of mutual funds are the focus funds. What are these? These funds can hold maximum of 30 shares in their portfolio at a time. Hence, these are buying only focus shares in which the fund manager has a high conviction. Hence, these can provide very good returns if the view of the fund manager is correct, but can underperform with a good margin if the view goes incorrect. In all the above categories, mutual funds cannot have more than 10% exposure to a single stock. The 11th category of the funds is the thematic or sectoral mutual funds. These funds invest money in a particular sector or theme. There are different thematic funds like BFSI investing in banking and financial sector, manufacturing funds, infrastructure funds, technology funds, power and energy funds, defense funds, and so on. These are suitable when an investor believes that a particular sector or a theme might outperform the market. In these funds, mutual funds can invest even more than 10% in a single stock. Hence, these are high-risk funds with a potential of higher returns. The 12th category are the index funds. Another fund category that is becoming very common these days is index funds. These are passive, low-cost funds that replicate one or the other index. One of the common indexes is Nifty 50 or Sensex. These funds tend to replicate the performance of their respective indices. There are new indices that are being launched from time to time. Hence, it becomes important to invest money in the indices based on your risk appetite. All the mentioned categories should not have more than 10% exposure to a single share, except for the two categories, that is index fund and the thematic mutual funds. And this concludes the video on the topic. In case of any queries or if you think I have missed something important, please use the comment section. Thank you for watching the video.